Look at this photo of a trading floor. For decades, this chaotic, hyper-competitive environment has represented what most of us believe about investing, that the stock market is a meritocracy, won by the smartest, most actively informed people in the room. Trillions of dollars are handed over to professional fund managers every year based on a very straightforward logic. We assume their Ivy League degrees, their Bloomberg terminals, and their armies of analysts give them an edge over the rest of us. But the raw mathematical data proves the exact opposite. All of that effort, analysis, and intelligence routinely fails to beat a strategy you can set up on your phone in 5 minutes. Every year, Standard & Poor's publishes the SPIVA Scorecard. It is a comprehensive study that directly compares the performance of professional active fund managers against a simple benchmark market index like the S&P 500. This chart visualizes 2025. 79% of active large-cap managers underperformed a basic index fund. You might assume a bad year is an anomaly driven by volatility, but when we extend this timeline, the failure rate climbs to 86% over a 10-year horizon. This reveals a counterintuitive reality about the financial system. If mindlessly buying an index fund, essentially doing nothing, beats nearly 9 out of 10 financial professionals over a decade, then activity and expertise aren't the drivers of success. The first reason professionals lose is the math of their own fees. An actively managed U.S. equity fund charges an average expense ratio of roughly 0.60% per year. A basic index fund charges about 0.04%. This graph illustrates what that 0.5% difference looks like over a 30-year investing horizon. On a $50,000 initial investment, the active fund costs roughly $70,000 more in fees alone. That money is gone before you see a penny of it. And crucially, the fund manager collects that fee every single year, regardless of whether their stock picks actually beat the market or lose value. High fees are not a premium paid for performance. They are a guaranteed penalty paid merely for the attempt. The second problem is how markets process information. Every major publicly traded company is scrutinized simultaneously by thousands of well-funded analysts trying to find a competitive advantage. The economist Eugene Fama, pictured here at the University of Chicago, won a Nobel Prize for defining why this is a problem. He called it market efficiency. Because every piece of public information, from earnings reports to supply chain disruptions, is instantly analyzed and priced into a stock by these massive teams, finding an asset that is genuinely priced incorrectly is almost impossible. The sheer density of brilliant minds analyzing this same data creates a state of competitive gridlock. And when everyone has access to the same elite intelligence, short-term outperformance becomes more about luck than skill. The issue isn't that Wall Street lacks intelligence. It is that the professionals are trapped in a system where they are each other's biggest obstacles. The third reason is purely psychological. Even in the rare instances where an active fund does produce market-beating returns, the human beings investing in that fund rarely capture them. Look at this volatile market chart. Financial research from Dalbar shows that the average investor earns roughly 2 percentage points less per year than the actual funds they hold. This happens because we are often wired to do exactly the wrong thing at the wrong time. We feel confident after a rally and buy at the peak. Then we panic during a correction and sell at the bottom, locking in our losses. Market volatility is a normal function of the economy. Our own instinct is the actual threat to our wealth. None of this data is a new discovery. In 1975, Jack Bogle launched the first retail index fund based on these exact principles. Wall Street aggressively mocked his idea of buying the whole market, calling it Bogle's folly. Today, the company he founded, Vanguard, manages over $7 trillion in assets. The S&P 500 index fund is now the single most widely held investment vehicle in the world, and the ultimate endorsement comes from Warren Buffett. He has publicly stated that his specific instructions for his wife's inheritance are to place 90% of the money directly into a low-cost S&P 500 index fund. The single greatest active stock picker in financial history is explicitly telling you not to pick stocks. These mathematical realities are playing out inside your corporate 401k right now. Most standard retirement plans are currently losing money to invisible expense ratios that erode your balance every day. Your first step is to log into your retirement portal today and find the specific expense ratio you are being charged. If that number is above 0.20%, look for the index fund alternatives on your platform that charge under 0.05%. This pie chart demonstrates your second step, replacing complex stock picking with a 3-fund global portfolio. You only need a U.S. total market fund, an international fund, and a bond fund. The final step is the hardest one psychologically. Automate your monthly contributions into those low-cost funds and refuse to react to scary financial headlines. The financial industry profits from your activity and the complexity of its products. You can bypass that system by doing the opposite. Buy everything, pay almost nothing, and wait a long time.